Yeah, so I mean, the risk would be just like, if bonds continue to sell off, as inflation continues to run hot, that's going to be terrible for equities. And, with that, the market over the last 2 years has gotten extremely levered up. Debt to GDP is at, very close to an all-time high. And so, if the Fed keeps tightening into this current macro environment, you're looking at a high likelihood of, a recession or, potentially something worse.
All right. Welcome back, everybody, to Altcoin Daily. My name's Austin, here with macro, on-chain, crypto market analyst, Will Clemente. Thanks for joining me, man.
Hey, Austin. Good to see you, man. It sucks we didn't catch each other in person in Miami, but hopefully next year we'll bump into each other.
Hopefully next year. That Bitcoin conference was huge. I know you gave a great talk, posted some clips on your Twitter. Maybe for those folks that didn't get to attend the Bitcoin conference, what did you enjoy the most, or what announcement spoke the most to you?
Sure. I guess I'll start with the first part. I mean, it was just meeting everybody in person was so sick. I have, the fairly large Twitter following, but I never meet anybody in person. And so seeing Bitcoiners in person was really cool. Both people that I look up to, as well as just people who follow my stuff. Really good vibe there. Everyone's super positive. Had all good interactions with everybody. And, it was pretty wild that people were recognizing me. It's like I never walk around thinking anyone's going to know who I am. But, at this little niche event, it was like every other person knew who I was. So that was pretty weird. But it was awesome, man. It was awesome. Announcement wise, I think like the Jack Mallers stuff was kind of the headline. Integration with Spotify, as well as just
Shopify.
Integration. Shopify. Sorry. Thank you.
Yes.
And then integration with just like the broader retail payment processors. Those really cool, being able to use Bitcoin at any major retailer, is a really cool step forward for Lightning. So, that was really sick. Yeah. And then, just generally, cool speakers all across the board, Kathy Wood, Michael Saylor, Preston Pish, Jeff Booth. I mean, all these guys, even
Kevin O'Leary.
Kevin O'Leary was sick. Peter Thiel did an awesome keynote. Peter Thiel is a lot more bullish on Bitcoin than I guess I had realized until he did that talk. So that was really sick. He threw a couple memes up there, which I got a laugh out of. Serena Williams, I didn't know she was into crypto, so that was cool to see. I mean, it was incredible, man, and can't wait to run it back next year.
Definitely. I definitely look forward to going back next year. For the folks at home, the Jack Mallers announcement was tons of retail stores across America, possibly globally, point of sale purchases, use Bitcoin if you want it, which was huge. And dude, I'm not surprised people wanted to come up and take pictures and see you, because you always offer such great substance from a data point of view in this space. So maybe just to tee that off, let's get to the data, man. What's happening macro and what's happening with Bitcoin?
Sure. Now, first of all, thanks for the kind words. I think we could just dive in and run in, through a few data points from our weekly newsletter, which we sent out yesterday. So probably the, most up-to-date organized document of, I guess, my general thoughts. So we could kind of start with macro. I think kind of the main, driving point, and as everyone probably knows, at least to some extent, is inflation has been running extremely high. CPI print came in at 8.5%, which is like a 40-year high. And so that's translating into fixed income selling off. So the way to think of this is, if you're holding a bond right now, we look at the 10-year treasury yields, they're at right now about 2.83%. As of the chart I put in here yesterday. When we compare that to CPI inflation, that means that real rates are at an all-time low. So the difference between CPI and the 10-year rate is 6.2%. And so, obviously what that is essentially telling you is that you're signing a contract to lose money, in essence, if you're holding a bond. And so with that, bonds have been selling off. So when bonds sell off, the yields go up to incentivize a new market participant to step in and buy it. And so that's kind of how that natural kind of market dynamic works. And so, with that, yields going up means that bonds are selling off. And we kind of in this chart, if you look at the U.S. 10-year yield chart,
I need you to share that chart.
Yeah, no problem. Hold on one sec. All right, you can see.
Yep, perfect.
All right, cool. Yeah, so here we're looking at the U.S. 10-year Treasury. As I just said, inflation has been causing the fixed income market to sell off. The 10-year is broken out of this kind of 40-year-long downtrend, which is quite concerning because honestly, I don't think anyone really knows exactly where yields are headed from here. If inflation keeps running hot, especially now, we've got a lot of supply-related issues, especially around food, with Russia and Ukraine being some of the main exporters of fertilizer. So macro is looking pretty kind of shaky to say the least. But one thing's for sure is you definitely don't want to be holding bonds in this environment. And so with this fixed income sell-off, so in times like this, fixed income is inversely correlated to equities. So the reason behind that is, think of it this way. So like a bond is essentially, investors call it a risk-free yield, right? Or risk-free rate, because the U.S. has never defaulted on debt ever. It just prints its way out of debt, right? And so as the risk-free rate is going higher, you're going to demand a higher premium for owning risk, right? Because why would you own a stock that's going to give you a 5% return? Just making up a random number. Oh, it's going to give you a 5% return when the bond is yielding 5%, right? Because there's no risk attached to that. So investors need a risk premium to go into equities and go further out on the risk curve. So as the yields rise, as bonds sell off, that causes a sell-off in equities as well. And so that's kind of why we've seen this rollover in equities over the last few months. I think January was one of the worst months for stocks performance, month-over-month performance in the history of the stock market. Obviously, it's pretty much down only in equities, and a lot of that has to do with this sell-off in the fixed income market, and that's translated into Bitcoin. So whether we look at it this way or not, I think a lot of us, including myself, kind of view Bitcoin as this inflation hedge. The kind of broader market participants, especially kind of the traditional finance folks, have been basketing Bitcoin in with tech stocks and just broader risk assets. And so, as we've seen this kind of risk sell off, that's translated into Bitcoin as well, just through correlation. And so, in my opinion, that's played a large role in this kind of rollover we've seen in BTC over the last few months. So.
And question on this before we move on.
Sure.
Is that just in the most simplified sense, is the risk if the bond or the 10-year, whatever that first chart we were looking at, is the risk that we lead into ultra inflation or ultra recession? What is the risk down the line if nothing changes?
Yeah, so I mean, the risk would be just like, if bonds continue to sell off, as inflation continues to run hot, that's going to be terrible for equities. And with that, the market over the last 2 years has gotten extremely levered up. Debt to GDP is at very close to an all-time high. And so if the Fed keeps tightening into this current macro environment, you're looking at a high likelihood of a recession or potentially something worse. That's kind of the bearish macro case that I think is circulated kind of the ropes on a lot of broader podcast platforms and stuff, but it still holds true, and it's still something that I think people need to be aware of, especially as the Fed continues to at least jawbone like they're going to continue to hike. They're expecting the market's pretty much priced in that they're going to be raising 50 bips at the next meeting, which still isn't even keeping up with the pace that inflation is running. So it's a really difficult time in general for investors, right? Because what do you want to own in this environment? As we talk about, you don't want to own bonds. They just broke out of a 40-year-long downtrend in yields. You don't want to own equities except for maybe some value stocks. Maybe you want to own gold miners, but in general, equities aren't looking extremely attractive. And so, that only really leaves you with, commodities. We've seen a lot of commodities skyrocketing, especially food related commodities. And then, potentially Bitcoin. I think it depends, though. Does the market view Bitcoin as a tech stock versus a commodity? I think lately they've been kind of basking in more with the tech stocks. But I personally, I think a lot of people who are just dollar costing into Bitcoin do view it as this just store of value, inflation hedge asset. But again, as of lately, we've seen that heavy correlation with the Nasdaq.
Got you.
Cool. So let's go ahead. I guess we can dive into some more intra Bitcoin stuff. So I guess we can start with this. So this is like one of the most important kind of price levels that I kind of follow. This is what's called short-term holder cost basis. So this is essentially the average price or the aggregated cost basis of investors that have been in the Bitcoin market for less than 5 months. And so that's where the short-term holder aspect comes from. This has like a very behavioral kind of dynamic embedded into it. So as you can see, like in bull markets, this serves as support. So we look at 2017, early 2020, we look at September of last year. The kind of psychology behind that is in like a raging bull market, new market participants, as Bitcoin's just like ripping over several months, don't want to sell at a loss. So whenever the price comes and retests their cost basis, they kind of cease selling, or they add at that cost basis, and so that allows us to kind of push off this band as a support in bulls. Heading into the bear, though, you get this effect where there's a lot of people that come into Bitcoin, especially at the end of the bull market. They're just buying because it's going up only, and perhaps they don't have any type of broader thesis on the asset class. And so once they're underwater, meaning they're below the cost basis. So when price is below that aggregated cost basis, once price comes back up to that cost basis, they just want to break even and just get out of the market. So they're just saying, hey, look, this thing isn't going up like it used to be. I'm getting an opportunity to just break even. I'm just going to take my money and leave. And so that's why you see these kind of failed underside retests on the way down. Here in 2018, you see 1, 2, 3, 4, 5 on the way down. That's kind of the psychology that's like really embedded into what's going on there. Currently, it looks like we've gotten our second failed underside retest on that push above or attempt to push above 46, 47K. My point I'm just trying to get at here is I think this price band, along with looking just at other trend following indicators or other moving averages, is one of the most important areas for BTC to reclaim from a momentum perspective. So here at Blocker, we kind of view the Bitcoin market from a value momentum kind of mental framework. And so what I mean by that is I think in the Bitcoin market, there's value buyers, there's momentum buyers. I think a lot of those momentum-based market participants step in above this area, above 47K, where this currently sits. We view value as the low 30s, but momentum above that 47K area. So right now we're currently just kind of hanging out in no man's land, as we're not in either of those areas. But again, for that momentum-based market participant, cohort, I think this is one of those areas that you should be watching for them to kind of step back in.
So just basing off history, and obviously history is not guaranteed to repeat, but just using that for now, would you guess, unless we have some big catalyst that changes the game, that we see a continuation or a repeat of what we saw in 2018, where it just keeps getting rejected and rejected?
Yeah, I mean, especially given the kind of the macro environment, I wouldn't be surprised. But I think in this current environment that we're in, obviously again, like very tricky time to be a market. So I think you just set parameters for yourself instead of trying to predict like what's going to happen, right? So like instead of trying to say, I think we're going to continue down, or you set thresholds for yourself, right? So you say, I think value is the low 30s. I think momentum is above X. For me, that's 47K. So you simply say, okay, if we get above 47, if we close above 47, I'll step in as a momentum market participant. If it goes back below, okay, I'm out. I'll set my stop loss below that. And then, same thing with value. Okay, I'll be a buyer in the low 30s. If we break below that, well, that invalidates my idea of what I thought value was in the market. And so I think now's, a time to play defense. And with that, you want to more than ever speak in kind of this if-then format than necessarily trying to say this is going to happen, if that makes sense. So again, set these parameters for yourself and let the market really tell you what decisions to make.
Definitely. That makes total sense. And honestly, that's a smart, it's way, having a plan like that is way better than just trying to predict, for sure.
Sure. Yeah. I mean, and especially again, so much uncertainty. You could see contagion effects from everything going on in Russia. I just don't think anyone is fully grasps a lot of kind of the second, third order effects of what's happened over the last couple months. And with that, I think it's difficult to kind of predict exactly what's going to happen in markets in this kind of broader, 2-3 month type of time frame.
And Will, give me 1 to 2 more charts, then just flip it back and talk big picture.
Sure. Yeah. This is a good one. So this is looking at exchange outflows. So this is the 30-day change in exchange balances. And so what this chart is showing you with kind of the boxes I've put here is that over the last week or two, we've seen the strongest rate of outflows from exchanges in a long time. The only other times that we've seen, this rate of outflows get to this area was after March of 2020, at the end of 2020, and like in late November, early December-ish of 2020. A lot of that was probably the grayscale, people sending BTC to do the grayscale arbitrage trade. And then September of 2021. So again, unprecedented outflows. The fourth, strongest rate of outflows we've ever seen in the market's history. So again, showing you that, people are pulling coins off of the exchanges. And a lot of that's probably been, Dokon and the Luna Foundation Guard buying at least, a good portion of those outflows.
And Sailor.
Sailor as well. Yeah. Sailor leveraging up his BTC to buy more BTC. We love to see it.
But just on that chart you just showed, and we shared that on our channel the other day, it's like that tells me that, whoa, these investors don't see Bitcoin in the tech basket, the sell-off risk asset. They see this, they must see this as a great hedge against the macro environment if they're accumulating all this at this rate.
Yeah, for sure. I think there's two kind of like combating cohorts of market participants right now. You have the kind of underlying, crypto native people who view Bitcoin as this, store value asset, or people who just have this long-term bullish view on BTC. And at the same time, you have these, more Wall Street traditional finance people who view it as a tech stock. And so, I think you're kind of seeing a battle, I guess, for lack of better terms, of kind of those two cohorts. But, underneath the surface, you're absolutely seeing, strong accumulation from these, long-term holders. So here's another chart to illustrate that. This is the amount of supply that hasn't moved in at least a year. And so the kind of idea here is that supply gets locked up. The more supply that gets locked up by long-term investors, it's easier for the market to rise because there's less available supply. So once the marginal bidder steps in, there's less, available supply for them to buy. Therefore, they have to drive the price up to accommodate for that new demand. You've only ever seen the amount of supply that hasn't moved in at least a year get up to these areas 2 other times, at the beginning of 2016 and at the end of 2020. And as of last week, we've actually reached the highest amount of supply that's ever not been moved in at least a year, which is 63.7%. So again, kind of to your point, there absolutely is this kind of, army of long-term holders beneath the surface, locking up their BTC and holding it in this kind of time of uncertainty.
Love it. Love to see it.
Let me see. Maybe we can do like 1 or 2 quick ones. Just cut me off if you want.
No, I love this. Anything that's you're passionate about that's relevant to you, our audience likes.
All right, cool. Sounds good. Here's another one, kind of illustrating some of the accumulation we just talked about. This is looking at all the entities with more than 1,000 BTC and then filtering out exchanges, Grayscale, the Purpose ETF, QBTC, OTC desks, all these known on-chain entities that we are tracking, right? And so this kind of gives you what I call the filtered whale balances or raw whale balances. As you can see, whales bought from mid 2020 all the way up into early 2021, and they sold down from March all the way down into the summer, pretty aggressively sold down. And then from there, they started buying from the end of the summer up until about September, and then distributed back into the end of last year. they accumulated again at the beginning of January, right around kind of the bottom. You especially saw this little spike here right at the bottom. And then they sold back down, especially on this rally here. They sold down fairly substantially. And then over the last few weeks, though, especially over the last week, you see this big uptick right here. You have started to see them reaccumulate their coins again. So again, still in a overall downtrend right over the last 6 months, but kind of on a local term, we have started to see this reaccumulation from them, and we'll be watching to see if this becomes kind of a trend shift, right? If we start to see their holdings just keep rising, get above kind of these areas, I think it would be safe to kind of call it a trend reversal. But for now, it does, I don't think it's safe to say yet that we're out of this kind of downtrend in their holdings. But over the last few weeks, we have started to see them tick up, which is quite interesting.
And essentially, in the last 6 months, we've just been watching whales play whale games, is what it looks like to me.
Yeah, I mean, I think a lot of the retail market participants, a lot of the speculative euphoria that's been in the market, throughout 2021, a lot of that's got flushed out. We can see that in several measures. The easiest one is just looking at like Google search trends. And you've seen that come down substantially over the last 6 to 9 months. Another thing is looking at like the amount of transactional, from an on-chain perspective, looking at the amount of transactional volume coming from large entities versus small entities. We've seen transactional volume over that time period you just described over the last 6 months, really just getting dominated by these larger players. So I do think that's that's definitely a trend that we've seen, is a lot of these just speculative market participants people are just YOLOing on Robinhood, like that whole group is kind of cooled off a bit, at least in the Bitcoin market. And what's left is, in my opinion, just these long-term holders, and then as well as you talked about whales. So
100%. And just looking at YouTube engagement and per video, very specific to me, it's like retail has left.
Yes, absolutely. I see the same trend in my Twitter following and engagement as well. So it's definitely, I think that's a very valid data point to look at our account growth as, not to like necessarily like talk up either of us, but just as, an objective fact of saying, hey, look, like we have fairly large platforms, the engagement on the platforms has come down. So that's telling you that the amount of user growth in the network is slowing down. I think that's very valid to look at.
And I will say the people that are still here, still subscribed, still wanting to learn, like those are the people that, are in the we all gonna make it camp long term. So if you're still here, appreciate you.
Yes, I agree with that. This is the last one we'll look at. This is a liquid supply. So this is a metric I created with Willy Woo back last summer. Essentially, you're looking at the movement of coins from weak to strong hands. The way I'm defining that is based on the spending history of the entity. So what I mean by that is the amount of coins that they take in versus they sell. So illiquid, when I say illiquid supply, that's defined as the group of on-chain entities that take in and sell less than 25% of their coins. So for every 4 coins they take in, they sell less than 1. Or in other words, they hold at least 75% of the coins they take in. And so you run the kind of comparison of those entities to the entities that are in and out of the market all day. The kind of day traders, market makers, just people who are hopping in and out of the market. And when you see a movement of coins from those people who are in and out to the entities who sell less than 25% of their coins, you get an uptick in this ratio. And so as you can see, again, over the last almost year or so, you've seen this perpetual increase in this, but over the last 2 months, you've seen this take a big leg up. And so again, I think a fair portion of this is definitely Do Kwon and Terra, but nonetheless, it's not all of it. I think a fair amount of this as well is just long-term holders continuing to add to their BTC amidst kind of this, global uncertainty. Right. This is another thing in confluence with like the other 2 things that we looked at. Just the high level is just the fact that a lot of the the holders are still here and they're still holding strong.
Let's flip the camera around and give me a summation, like everything we talked about in terms of what's happening globally, macro, and then how Bitcoin relates based on the data we're seeing.
Sure. Yeah. So, I mean, looking at macro, inflation running hot, 40-year highs. That's caused a sell-off in the fixed income market. The 10-year yield has broken out of a 40-year downtrend. That's translated into equity selling off, in particular, risk-on assets. The kind of market participants that have dominated the market over the last 2 years, have gotten in over the last 2 years, have been basketing in BTC with those risk-on assets, especially tech stocks, which has caused this kind of sell-off and general weakness in the Bitcoin market over the last few months. However, underneath the surface, a lot of the kind of intra Bitcoin metrics still look very strong. We've seen a nice cool off in the derivatives market. We've been in a regime of spot premium, meaning that spot is above the derivatives price for a prolonged period of time, which is showing that kind of cool off and reset in a lot of that, speculative euphoria. A lot of retail statistics have kind of cooled off. So we've seen a lot of those, a lot of that exuberance kind of step out of the market, cool off out of the market. And then as underneath the surface on chain, you've seen strong accumulation through several measures, including look at the spending history of coins, the amount of time they've been in the market. And as well, we've started to see over the last month or so an uptick in whales holdings, although we still are in a broader downtrend. So again, macro weakness, intra Bitcoin stuff still does look strong though. And I suspect once the macro tides turn, you'll see Bitcoin really rip, especially as that float remains held by those long-term holders and they're not selling their coins.
And what do you think we need a catalyst for to end the short-term downtrend that we're currently in? Like, what do we need?
Sure. So I think like one, more concerning thing, but higher probability thing would be something breaking in macro, and that could potentially cause the Fed to pivot their stance. Whether that's inflation, well, it could be inflation starting to decline and the Fed feels like they can take their foot off the gas. So that's possible, especially towards kind of like the latter half of the year. The other thing would be if we started to see like a substantial sell-off in equities and the Fed, let's say NASDAQ sells off another 15-20%. I'm very strongly confident that the Fed at that point would step in and say, okay, hold on. We're going to back off the tightening, or they'll probably start easing again. And the other possible, scenario would be like if fixed income continues to sell off, eventually the Fed might have to implement something like yield curve control, where if there's no bidder on bonds, if bonds keep selling off, that's going to break everything, right? So if there's no bidder on bonds, at some point the Fed might have to step in and say, we're just going to, and this is like what they do in Japan, is they just step in and say, we're going to peg the yield at this. And if it sells off anything beyond that, we're buyers. And so they essentially have this artificial stop on where yields can sell off. I think that's very possible within the next year or so. But just from like a high level and kind of layman's terms, it's just some of this macro uncertainty clearing out, I think would be the most obvious catalyst. But there is, of course, the potential for some type of idiosyncratic flow or like unique flow of capital into BTC for any reason, from a spot ETF, which I think is personally unlikely this year, but that's possible. Or, other countries following El Salvador, or, another country, looking to, just take, a broader positive stance on Bitcoin. Some of those things are possible. We've seen like Russia hinting to using Bitcoin potentially for energy transactions, some of those things. But generally, as long as we're correlated to tech stocks, you're going to need to see macro kind of cool off, and some of that cloud of uncertainty fade.
And final question before we do final thoughts.
Sure.
Have you personally been increasing your Bitcoin position over the last few months, or your cash position over the last few months?
Sure. Yeah. I mean, I always, I have a DCA, if you want to call it DCA portfolio, and a trading portfolio. So in the DCA portfolio, I'm still stacking as always, buying Bitcoin every week. In my trading portfolio, I am still in this kind of general, more risk off stance, just because I think there still is a non-zero chance of there being some type of contagion event, given everything that's kind of going on. But it's not majority cash, because I think the asymmetry of betting on something like that isn't there. Although it's a non-zero chance, I don't think you should be placing your whole portfolio betting on that happening. Because I do think if the macro tides turn, Bitcoin's going to be the first thing that rallies off that, just as it was the first thing to sell off on the tides turning the other way. So I would say I'm probably 80-20%, actively in the market versus in cash in that trading portfolio.
The links for Will Clemente are down below in the video description. Final thoughts, man, for the Altcoin Daily audience.
Sure. Yeah. I mean, I think if you're a long-term holder, a lot of kind of the metrics that I look at are pointing to this being, a good, fantastic time to average into BTC. I think if you've got a 2, 3, 4 year time horizon, we're going to look back in years from now and be like, wow, I wish I had bought more Bitcoin in the low 40s. And so, I think for traders, maybe you just hold off on trading until the market goes from hard mode to easy mode. Otherwise, you set those parameters we talked about, set a momentum threshold for yourself that you step in if Bitcoin shows you momentum and get back out if it breaks below, let the market show you that. Or you set a value threshold for yourself where you decide that you want to allocate heavily, throw in a lump sum. And then again, for those DCAers are going to keep DCAing, right, no matter what. So
absolutely. Will, thanks so much, man. Love the perspective. Appreciate you.